I was down for the Clemson game where we beat number 9 ranked teams in the country. And let me tell you where our 5 offensive linemen come from, okay? We have 3 Duke guys. We have a transfer from Stanford and a transfer from Harvard. And
Wow.
that is our starting offensive line.
It's a very high.
Hardest offensive line in the country. Okay? We have 3.
Okay, sorry. This.
Yeah, let's go ahead and get started in a minute or so, because
yeah, let's go. Oh, give me 1 second. I'm shooting this. Give me 1 second.
Just to follow up, I've got 2, not 1, but 2 Duke NIL meetings this afternoon, just to give you a sense of how much time I'm spending on this stuff.
All right, okay. All right, we're starting. Okay, less people are coming in.
Is the link already live, Fabian?
I WhatsApp the link. Okay. All right, we're starting. Check your WhatsApp.
Okay, I see
yeah.
here.
Okay. All right. I think we go. So your people are coming in. I think we can get going. All right. Good afternoon, everybody. I'm gonna switch to my beautiful accentless English because we have Jay with us.
Same here.
And so you guys know Jay. And before I give the floor to him, I want to say 2 things. First, I want to review some notes for April because Jay, as I say, we need to take credit when it goes well because eventually it's going to go bad one day, right? So take credit when it goes well. Then we'll get the spank. And also, I want to finish when Jay finished. Some of you have asked me, and there is a way for you guys to use Jay's product. So to have his TPW investment management manage money the way he expresses, there is a way for you to access that in a managed form. Just not, as we say, leaving the generosity of Jay that give us his views on the world. So you can use that. So I'll talk about that at the end. So Jay, without further ado, April 5th was the last time we talked, and here are some of the highlights. That was the top of AI. Everybody was talking about AI. And you said something very, very interesting. Discount the things from the past, because now anybody and everybody have access to the past. So you can say, give me the last 52-year returns for the month of January, and ChatGPT will give it to you. So everybody has that access. Before it was a mystery. People had to go and it was one of the biggest observations I've seen on AI, and that you made that one, that, the whole thing of digging the past is easy. However, as we have discovered, ChatGPT cannot create anything that does not exist. Okay. One of the best examples was I've heard someone talking about, if you ask ChatGPT to give you a story of the exploration of the moon, right? It will write it up, but it will also tell you that maybe everything is a lie, because there is equal content on the internet saying that the whole thing is a fabrication, that we really never went to the moon, right? ChatGPT doesn't know how to differentiate that stuff. So going past, a lot of good information, the issues going forward. Who has the creativity? And you said, have an independent human point of view will be very important. That's one of the things I like to hear. You highlighted something that we had from previous August, which is we are in a world of high nominal GDP growth. With this level of inflation, there is the GDP at the nominal level is very high. I think it's very, very interesting. The markets are being very fast. We went from inflation scare to recession scare, now to high growth scare and Fed scare. So we shift on a dime from one thing to the other very, very quickly. And if you're not paying attention, you can get caught. Another great observation. And
Jay was one of the earliest proponents of the 3% is the new 2%.
Well, there you go. Exactly. So it says the big theme, 2023 is return to stability, to normality. COVID is out. bottlenecks, supply changes, every labor market will be more stable, to share right there. We have a labor market that has been consistently not crazy, stable. There was, at that time, we were talking about with these regional banks issues. There was a fire break with the regional banks issues. You say, not going to get to majors. It didn't. The Fed is done. We had a Fed that, although it's having a hawkish language, it hasn't raised rates for a lot. And then the TPWIM, which is a product, you're focusing on climate, the future of tech, and innovation, okay? The other thing that we talked at that time, we had passed the Inflation Reduction Act, all these new sort of industrial policy statements. And as you say, for every trillion that the government spends, probably the private sector will spend 2-3 trillion. Problem is, no one has done industrial policy at the state level ever. We don't know how they're going to spend the money. Where's the money going to go? But that's, it's out there. Other thing is end of the yield curve control. I mean, as you've seen now, and this is another key call, Jay, we've seen finally the yields are raising, this whole artificial yield levels, even at the Bank of Japan, we go from 0.25 to 0.70. So, and needless to say, the United States, we speak about that every day at Winston, we're at 450 in the 10-year. So there. The one that probably didn't go as well, you've been saying China is very cheap. It's getting cheaper for now. I mean, it has a little bit of noise, but that was a little bit Russia is a paper tiger, another great call. They haven't won, they haven't lost, but clearly by the size of the army, they should have done in 3 weekends, and they're still there, stuck in the problem. Very bullish on Mexico and Brazil and commodities. Mexico has been one of the best performing markets in the world. Not as good as Argentina, but still very good. But yeah, Mexico, Brazil. You like the commodities, you like the stuff, and let me finish right there. At that time, you say that non-U.S. equity should start outperforming U.S. equity, right? So your allocation at that time, we're talking April 5th, was 65% equity, 15% fixed income. There is yields, there is coupon, and 15% commodities. You were bullish on the commodities, and as we talk, oil is about to touch 100 any second now. Without further ado, Jay, let me take my pen. So I'll start making notes. All yours.
Great. Well, as always, Fabian, great to be with you and Luis. Of course, we go back, many, many years together. And it's always great to be with you, and particularly these last couple times, because you're so effusive with all the things I get right. And so de minimis on the things I get wrong. And really, I greatly appreciate that. You have a side hustle as a TPW advisory publicist, my friend. So I appreciate all that. I also appreciate, your title today, Global Investing in a Tripolar World. And, it struck me as I was thinking about what to say today, that it's been 35 plus years for me doing global investing in global markets, and the last 28 or so in global multi-asset or global macro. And I marked that point being when we started doing global emerging markets back at Morgan Stanley, which was the first multi-asset, multi-regional research product that the firm offered, as you may recall. I also really appreciate the focus on the tripolar world. And for the audience, the tripolar world is a thesis that I've been developing for over a dozen years already. It really came out of the great financial crisis, when I was very critical of the focus on pure monetary policy and the lack of fiscal policy, and really the lack of government action to drive growth. And as we've seen, and we talk about still today, the 2010 to 2019 period was a period of low growth, low inflation, low interest rates, and it was an anomaly, in my opinion. We're not going back to that as we go through 2024, 2025. And I think that's part of what's being priced in to the long end of the bond market curve these last couple of weeks. So tripolar world is a thesis of regional deepening or regional integration in each of the three main regions of Asia, Europe, and the Americas. And really, of the last couple of years, we've been driving that thesis through a focus on what we call the 3 C's of COVID, climate, and conflict, all of which we believe are accelerating the process of integration in each of the 3 regions. And just think about, for example, what's gone on in Europe with the conflict and with COVID, the increase in kind of multilateral funding to deal with issues throughout the European Union. That coming out of the Ukraine-Russia conflict, the approach to the energy environment and the energy market. Now the focus on making sure that Europe has fab plants for semiconductors, has battery plants for electric vehicles. You think about Asia, there's so much talk of decoupling and de-risking from China. And yet what's happening is actually that China is the sun for the Asian ecosystem. Anyone who spent any time in Asia knows that. It's the 300-pound gorilla in the region. But what's happening now is that as people try to have a China plus one or a China or a multi-platform production capacity or supply chain realignment, they're putting China deeper into the ecosystem of Asia. Okay, that's a part that's not really being talked about, but is increasingly becoming a reality. So Asia too is deepening its integration as a result of what's going on geopolitically around the world. And then the third and final is the Americas, where arguably we have the most upside to integration because we've done so little of it post NAFTA and whatever the Trump version of NAFTA was a couple of years ago. But one of the reasons why we were so bullish on Mexico and talked about it in April is because Mexico is without a doubt one of the biggest winners of regional integration in the world. They are right next to the United States, which is one of the biggest consumers in the world. And so all of what's going on in terms of nearshoring and reshoring is driving tremendous fixed asset investing into Mexico and into the kind of the border of Mexico, because all the fab plants and EV plants are being put in Texas and right along that southern border. So Mexico's a huge winner. You pointed it out, Fabian. Thank you very much. We've been overweight all year. It's one of the best performing stock markets and the best performing currency markets in the world. So we see the world differently is kind of what I'm trying to get at TPW Advisory. We've got tons of years of experience. We've got lots of scars. We've got lots of things wrong. We've got some things right. But we are in the business right now of providing clients with model portfolio delivery. And we have a global multi-asset model, which is benchmarked to global equities, global fixed income, and global commodities. About 25 or so ETFs, all US listed, all ETFs, 100% ETFs. And then our second model is our TPW20, which Fabian mentioned, 20 ETFs, so limited to 20, focused on future tech innovation and climate. So that's how we express our views. We track our views. We measure performance. I have a 12-year track record that's been independently verified. It has significantly outperformed our benchmark, that global multi-asset benchmark I just spoke of, significantly outperformed the hedge fund global macro index to the tune of about 400 basis points over per annum over the course of the last dozen years. So, and the last thing I'll say about that before we get into the outlook is that the bulk of my own personal money is invested in that global multi-asset model. So my clients and I, we eat together or we don't. And as you can tell, we eat because, you know, I'm not that skinny. Not like Luis, who still has that swimmer body.
Oh, yeah, for sure.
Okay, so the outlook. And Fabian again mentioned it. A year ago, our 2023 outlook was entitled Return to Stability with a question mark. And so we really saw it as the opportunity to kind of move past COVID, move past the inflation spike, move past the developed market central bank rate hike cycle and get to some sort of stability. And lo and behold, here we are, you know, a year later, and we're kind of approaching that point, and we'll get into that in a second. Over the last kind of 9 months or so, we've been talking about a middle path, a path between high inflation and deep recession. And that is something that we have been big believers with the focus, again, as Fabian noted, on high nominal growth, which drives directly to earnings and revenues. People have to remember, and they forget, because it's been many years since we've had high nominal growth, that earnings and sales are measured in nominal dollars or nominal euros or nominal yen or whatever, reals, you know, pesos, doesn't matter, nominal. And so if you understood that nominal growth in the US this year was going to be 6 or 8%, which is kind of what it's tracking to, then, you know, it's really hard to get big earnings shortfalls. And that's one of the reasons why the equity market has done so well relative to where people were expecting. The vast majority of Wall Street strategists had a negative return year for the S&P, just like almost every economist had a recession penciled into 2023. Neither has occurred. So over the last 2 to 3 months, we've been talking about transition and transition time, which was the title of a musings, or traction, which was the title of another musings. That talking about the transition from inflation to disinflation, from rate hikes to rate cuts, from inventory destocking to inventory restocking. And so all these things we think are in process. And then last week, the Fed validated the bulk of this line of thinking. And to me, it was extremely important, and not for the reasons that the market has seemingly taken on board with all the cross-asset selling. The Fed, and as I see it, is now more in line with reality than at any point since pre-COVID. And that's really critical. They are closer to reality. Their forecasts, particularly the economic forecasts, are closer to reality than at any point since pre-COVID. Remember, over the last couple of years, they got inflation completely wrong. They doubled their GDP forecast for 2023 last week, doubled it. They significantly increased their 2024 GDP forecast. They took recession off the table. They validated our middle path, which others call soft landing. They also validated the cross-asset market action that we've seen year to date. They validated the bond bear market. They validated the commodity bull market, which again, thanks to Fabian, we know that we have been significantly overweight commodities and were very bullish commodities back when everyone else was calling for recession. They validated the equity outperformance and the earnings revision indicators. They validated credit significantly outperforming sovereigns. So the Fed, as I see it, is back in reality, and they have taken recession off the table in return for 2 fewer rate cuts in 2024. And to me, that is an absolute great trade for risk assets. Now, one of the knocks on me is that I get referred to sometimes as a perma bull. And I just want to highlight the fact that we have been out of treasuries and massively underweight fixed income for the last 2 years. So we have completely avoided the US Treasury implosion, which is one of the worst bear markets in the history of the US Treasury market. So when you hear Pelosky and you hear perma-bull, remember 0 allocation to US Treasuries in a benchmark that's 40% fixed income. Okay, so I think that the Fed is closer to reality. I think they have correctly taken recession off the table. That's a great trade. I'll gladly trade 2 rate cuts, which would only be necessary if recession was coming, for no recession. And so are things great? And can we, go off to the races? Well, there are a couple of things to be concerned about, right? And of course, the mass media is busy trumpeting them from every rooftop. You have the UAW strike. You have the government shutdown in the United States. You have rising gas prices. You have student loan repayments. It's called quadruple threats. I think that was the title of a Bloomberg article I saw the other day. Now, again, those of us who have been in the business for a while know that stocks are forward-looking discounting mechanisms. And so all of this, I believe, is already in the price and is reflected in the seasonal selling that we have seen over the last month or two. August and September, historically poor months for equity returns. The last 2 weeks of September, among the worst 2-week periods of the entire year for the S&P historically. And I think it's interesting to note that seasonality seems to be working again. And that is a tribute, in my view, to a return to that stability that we've been talking about, right? When things are stable, then history has, some utility to it, some heft. When things are ahistorical, which is what I've been calling the last 3 years, ahistorical, meaning doesn't usually happen, not too many examples in history. You have to go back 100 years to the great influenza flu of 1918 to 1920 to see anything like what we've seen globally with COVID. So we're going from ahistorical to some sort of normalcy, a return to stability, which allows for things like seasonal factors to have more impact. And no surprise, we have quadruple threats, which are leading to risk asset selling at exactly the time when we should get risk asset selling. Now, going forward, what does that look like? It looks like some of the best months for the S&P of the entire year. So I'm of the view that we're getting to the end of this selling. Let me give you a couple of reasons why. One is month end and quarter end selling is going to be done here in a day or two. Another is that the IWM, small caps to S&P, has stopped going down. The third is that tech is outperforming on a day like today when the 10-year is selling off significantly. The fourth is that, it really hasn't been all that bad if you go back even just a couple of months. So here's through midday today, through about noon today, over the last 3 months, ACWI is down 2%. The S&P is down 1.5%. The Qs are down 1%. FXI, China, which we all know is just absolutely imploding, is down 2%. And KWEB, Chinese tech, is actually outperforming the Qs and is flat over the last 3 months. One more example of why we're close to the end. The short-term RSI of the S&P is at 28. It's oversold. And the RSI for the US dollar, DXY, is at 79. Very, very overbought. And one of the things that's pushing here at these last couple of days is that the hedge fund community, the supposed smart money, is completely confused and is busy jumping on whatever trend is out there to try and capture a little bit of performance. So the hedge fund community is long oil, long the dollar. They are the most short US equity since March of 2020. We all remember March of 2020 was COVID. Hedge funds are as short today as they were then, okay? And they're the shortest they've been in the US Treasury market in well over a year. So to me, the focus forward, and we're big believers at TPW, and again, Fabian touched on it, the past is useless given AI. We are big believers in focusing forward. And what we're focused on is an epic reversal of some of the trends that we've seen in the last couple of months in the markets. And so we're focused on what we call the 4 signposts to stability, which we believe will unlock what we call the $1 trillion reward. That $1 trillion reward refers to the $1 trillion that has gone into US money market funds year to date, expected to be around 1.5 trillion by the end of the year. And so when we return to stability and a penny drops for everybody, that $1.5 trillion is going to start to look for a little bit more risk. And we want to be positioned in that stuff before that reward money gets unlocked. So here are the 4 signposts that we're watching for stability. The first is continued disinflation in the US and Europe. As we put it in one of our musings, DM rate hikes are tired, EM rate cuts are wired. Focus forward, not backward. The second is a global manufacturing recovery as we shift from destocking to restocking. And we're watching things like new orders to inventories. That ratio is creeping up around the world, not just in the US, but globally. And JP Morgan reminds us that the best time to buy stocks is when the PMI is under 50, manufacturing PMI, under 50 and rising. And that is exactly where we are today. The third signpost is continued improvement in earnings revisions. And here we note that Bank of America recently reported that its 3-month moving average for global earnings revisions has hit its highest since the spring of 2022. And then the fourth is, and importantly, is that the drips and drabs of policy stimulus in China gain traction. When you're in periods of transition, you want to focus on what gains traction. And so we're really looking to see those policy moves in China to start to grab traction. Okay, so let's talk about China and finish up with kind of what we, where we are currently positioned. And then we'll take some questions. I'm sure there'll be some. So I was on Bloomberg Asia on Monday night. It was like not even 2 nights ago. It seems like a month ago. And I told the anchors that I thought long China equity was the single best global risk reward opportunity between now and year end. And, everybody knows TV time is very, very fast. There was complete silence from the 2 anchors on Bloomberg.
I saw the video.
They were stunned, right? I'm not exaggerating, am I?
Yeah, they're very skeptical.
Yeah, stunned and skeptical. So, they came back with, what about Evergrande? And I was like, Evergrande has been a story for 2 years. It's down 95+% from where it was. It's completely meaningless. And look, again, it's not just me talking. We own in our model portfolio and personally, KHYB. KHYB is Asia High Yield. It has about 20 to 30% of its allocation of its positions in China real estate. And guess what? On a total return basis, year to date, it is outperforming Barclays US Ag. Okay? Asia High Yield, 30% China property, outperforming Ag. So that's what counts, not the talking heads, not, oh my God, yet another story about China property and real estate, the reality in the marketplace. So as we see it, let me give you 4 or 5 or 6 reasons why we like China equity right here for the rest of the year. And I know Fabian is writing this down, so we'll see the next time I'm on how this works.
And this time I'm writing too.
Yeah, and granted, we were constructive on China in the spring. We got less constructive over the summer, and we got back involved about a month or 2 ago. Just so we're clear on that positioning. China equity trades at a record cheap discount to the United States. Now that can be said about lots of markets in the world, but it's at a record cheap valuation to the US. There was record foreign selling of China equity last month in August. Record, never before have foreigners sold as much as they did last month. August industrial profits for China just came out today, were up 17% year over year. The estimate was down 5. Up 17 actual versus estimate down 5. JP Morgan's business activity indicator for China is at its highest point of the year. And that led JP Morgan last week to upgrade China GDP for Q3 and Q4. Upgrade, not downgrade. Most importantly, the year-over-year comps for the next 6 months are going to be extremely easy to beat. Extremely easy to beat, because a year ago, China was going into lockdown. Remember the pictures of Shanghai and Shenzhen and Beijing? That was a year ago. So here's the signal to the noise. Excuse me, I'm just going to take a little sip of water. We've heard so much noise about how horrible things are in China. You know, you don't have to go 3 feet or 2 clicks to find a negative story on China. Okay, Trip.com, which is the leading travel site in China, 2 days ago in a Bloomberg article reported 20 times increase in overseas bookings year over year. 20 times, not 20%, 20 times greater than a year ago. So that's the signal. We're going to get data like that for the next 6 months in China, after record selling at a record low valuation. And that is why, to us, it's one of the best risk reward trades out there. Now, does it have issues? Of course it does. Are they in the price? Absolutely. Is there a catalyst? Yes, the year-over-year comparisons. And that's how we learn the business. That's what you want to see. In the price, is there a catalyst for change? And can you position? And the answer to all 3 is yes. And therefore, we are overweight, significantly overweight. If you look at ACWI is 50% of our benchmark, and China is like 2 or 3% of ACWI, or maybe it's 5 or 6%. I'm not actually sure of the exact number, but nonetheless, we are significantly overweight China equity. So let me summarize kind of where we are in general. We're ending the worst seasonal period of the year for risk assets and about to begin the best seasonal period of the year for risk assets. The Fed has finally faced reality, and the bond market is 2. The US dollar, which is a key risk, we do not expect the dollar to continue to show strength as it has. It's on an 11-week win streak. The last time we had an 11-week win streak for the dollar was in 2009. We are not in any way, shape, or form in a 2009 environment. And the 10-year is at 2% in real terms, which is historically high. Bonds are very extended, as I mentioned earlier. And so to us, we expect the next 30 basis points of movement in the 10-year to be a rally. Rates fall, not rise. In our view, the global economy is in an early cycle recovery, not a late cycle heading to recession. We expect and have expected and have talked about for almost a year now, a global CapEx boom to deal with those 3 C's we mentioned before. We see AI as serving the same role as the internet did in the second half of the 90s to cap inflationary pressures. And that remains our analog. We think we're approaching in 24, 25, 26, a period very much like 1995, 96, 97. High growth, high nominal growth, low inflation, good earnings growth, good risk asset performance. So we remain overweight equities in our global multi-asset model, overweight non-US with a focus on the emerging markets and China in particular within that emerging markets. We've already talked about Mexico and Brazil, continue to own both of them. Brazil is the poster child for the emerging market rate cycle cuts. It's going to likely cut 400 to 500 basis points out of the CELIC over the next 6 to 12 months. That's going to support growth and support Brazilian equity assets in our view. We are deeply underweight bonds, particularly sovereigns. Though having said that, you know, at 450, 440, somewhere in here, bonds are probably don't have a tremendous amount of downside, but I don't think they have a whole lot of upside either because of the global economic recovery that we expect. We continue to be long credit, both in the US and in emerging markets. And we remain overweight commodities in the energy space, in the industrial metal space, in the precious metal space. And in our TPW20, we're overweight future tech, as well as some of the positions in the climate space. One position that's worked out really well for us has kind of saved our bacon in a few of the last couple of days is URNM, the uranium miner ETF. It's a 4% position for us, and we think it's got significant room to go higher over the course of the next year. The world needs baseload, steady, stable baseload power, and nuclear power is one of the few ways to get it. And the uranium market, I'm not an expert, but I spend a fair bit of time on it. The uranium market is effectively sold out for the next several years. And so price is going to have to be the arbiter of who gets what. And that means the miners are going to make a lot of money. So I'll stop there. And thank you for your time and look forward to your questions.
All right, Jay, 4 pages of notes. So we'll have to review later. But before we go to Q&A, one comment on Jay's product. As you know very clearly, we in Winston don't sell any products, but I think if you can access his product and the way Jay works, you don't have to move custody. You can keep the custody wherever you have. You just sign an agreement with Jay's firm. Minimum investment is $500,000. It's a 1% fee paid quarterly, and you'll get a report on what to do, you know, how to invest. As he says, it's all ETFs, it's all US listed ETFs. It's something that it can be put together relatively quickly and easy. And you will have a monthly meeting, a one-on-one with Jay, plus everything that he publishes. So that's, I think, Jay, I capture that. And again, if any of you have an interest, I have spoken with some of you. I will probably, what I recommend is, connect with us, with me and Luis, and then we'll have a one-on-one with Jay so we can go into more details, more granularity. So let me start with two quick questions, Jay, on that. One of the big surprises, and you mentioned that it's like most strategists and economists, but let's talk about the strategists now, because I think it was the most poignant issue. We're super negative this year for 2023, and they were wrong. Why do you think that was the case?
Well, it's a great question, Fabian. First of all, thank you very much for talking about TPW and our model portfolio delivery service. I will just add one thing, which is that as the assets under advisement, because we advise with the model, we don't manage. As the assets go up, the fee structure goes down. But that's the purpose of the one-on-one call that we would have, that you would be able to put together, in which we would look forward to. As you both know, I spent a lot of time at Morgan Stanley running different research products, starting with Latin American equity research, where Luis and I worked together, then with Amy Falls doing global emerging market strategy. Then the last product was the global asset allocation strategy product, where I co-chaired the research department's investment committee. And that product offered, everything that Morgan Stanley worked on. Every type of research, quant, technical, fundamental, every asset, FX, equity, fixed income, real estate, commodities, every region of the world, right? And so I have a lot of experience and respect for the challenge of integrating, lots of views from lots of smart people who really can articulate their view well. It's not easy. And so what you get is usually a blend, right? And it's really hard for a big bracket firm to have an economist saying recession and a strategist saying bull market, right? And so if you can't get, you have to bang those heads together and get them to agree. It's one of the reasons why I work pretty much by myself, right? Because I am offering my point of view. And it's informed by all my years of experience, by my relationships with people that I've developed over 30 years, by calls with people I respect on the sell side and the buy side, etc. But that's what you get. You get a clear, distinct point of view, as opposed to a homogenized, blended point of view that requires people not really having the freedom to say what they really think if they would just by themselves in their own silo. And I think that's got a lot to do with why Wall Street got it so wrong.
All right, good.
I have a question, if I may.
Yeah, go ahead.
Jay, one thing that you had it right that for me was when you first said that you like credit, I thought, Jesus, this is not going to work. So it was a surprise for me, the credit call right in the context of a short interest rate, right? So you're like negative on rates, but positive on credit, which I mean is a very rare combination. So okay, you definitely nailed that one. How you feel about you mentioned a little bit on the rate side. You mentioned the 10-year and what you expect, the 30 bips, etc. But what about credit? I am assuming that you continue to be positive on credit because you assume that the economy is right. And the second leg of the question is a little different, is energy, oil. I'm always puzzled by the behavior of the energy market. And considering your call for not a call for a recession, but a call for an early cycle. So do you attribute the energy prices as a byproduct of that bullishness of the early cycle, or you attribute a lot to whatever the supply issues that we are seeing, and how do you see that will play out? So sorry for the long question.
Yeah, getting two into one. I trained you well, my friend. Yeah, on the high yield and the credit, basically it was the feeling that there was not going to be a recession, that the ETFs that expressed those views were cheap because people were worried about recession and had sold them. That in addition, the credit mountain, particularly with high yield, you need to be aware of when the big repayment cycles come, right? When they need to refi. Because the high yield market shuts down more than the investment grade market does, right? And certainly more than the treasury market. So you want to be sure, if it's an uncertain environment, that refi mountain is not right in your face. And it's not in high yield. Because again, people don't remember that treasurers are smart guys in these companies. And when they had zero interest rates over the last couple of years with COVID, they refied aggressively, right? And so the high yield companies, their refi mountain doesn't come till 25 or 26. It's kind of like the whole mortgage thing, right? And people super bearish on housing. We've been quite bullish on housing and own XYB, I think. Let me getting my symbols mixed up. Yeah, XHB, sorry, XHB, in part because people forgot that the vast majority of people had fixed rate mortgages, because floating rate mortgages didn't exist really after 08. So fixed rate at 3%. So it doesn't matter if the credit market or the fixed income market takes rates to 6 or 7%. All it does is mean that the only houses available for sale are going to be new builds, which is great for the builders. And thus, XHB has been a great performer year to date. The other thing, and this is what gets to the beauty of the ETF space, is that there is an ETF out there that hedges out the interest rate risk, right? So that was beautiful for us, because we were bullish the business side, bearish the rate side, and yet you could find a vehicle that hedged out that rate risk. And I'll even tell everybody the vehicle, because we still own it, and it's working great. HYGH, and it's up 2% or so year to date versus ag down 3. 500 basis points of outperformance just on price. That's not a total return figure. So that's one of the things that, again, we bring to the table. I've been doing nothing but ETFs for something like 15 years. I don't really do anything with individual stocks. I don't do futures. I don't do options. I do one thing, because I can only do one thing. And I think in this business, anytime you're doing something which you're not an expert in, you're somebody else's lunch. And so we do ETF. So just to finish on the oil side, we've been bullish commodities because we're of the view that we're in early cycle, global economic recovery, no recession, and it's just been augmented by OPEC's decision to reduce supply. So you have demand remaining firm, and this is again an illustration of China. China's oil demand remains firm, okay? It's not falling off a cliff. It remains quite firm. It's suggesting that the economy is not in that bad a shape. But anyway, so our oil play is basically no recession and augmented by a supply impact of OPEC. But at this point, we wouldn't be buying oil or energy stocks right here because they're overbought, like the only part of the equity market that's overbought. Would be looking more at things like copper, iron ore, things of that nature, which have been sold, particularly over the last week or two, as people price in higher for longer, which suggests to some people greater likelihood of recession rather than less likelihood of recession, which I think is incorrect.
Thank you.
Thank you. Back to emerging markets that you like, and we talk about China. How about India, Jay? We don't talk lately about that. What's your view?
A lot of people like India because they don't like China. So, there's money out there. And again, we know very well, right? If you're Latin American dedicated money, or if you're Asia dedicated, or if you're emerging market dedicated, you only have a certain number of options. And so typically this year, where both Brazil and Mexico have done well, that's unusual. Usually one does well and the other doesn't. People just trade back and forth. Same in Asia. India and China both doing well is kind of unusual. And, India this year, there's been a ton of talk about it, but the performance has been, better than China, but it hasn't been particularly great. I mean, for me, I just think that China has better upside, and I'm not convinced that India is going to be this factory that China was. I don't think they have anywhere near the infrastructure. The currency is expensive. They have huge issues with energy needs. And so I've just not been, I see the upside as being better in China than I do in India. But those are my big worries. The factory of the future story is overhyped. The currency is expensive. Valuation is expensive. Equity valuation, much, much more expensive than China. If you look at the valuation history of India versus China, India looks quite expensive relative to that history, relative to China.
Thank you, Jay. And I think that concludes our thing. We almost had an hour. I want to thank everybody, especially you, Jay, for the time that you dedicated. And again, if anybody has interest in the product, please reach out to me or to Luis, and we'll do one-on-ones with Jay to discuss.